In January 2021, a struggling video game retailer's stock shot up over 2,300% in 12 trading days. Not because the company suddenly became valuable, but because of a mechanical trap baked into the market itself. The people betting against the stock were forced to buy it, and every forced purchase made the next one more inevitable. To understand how that trap works, start with what short selling actually is mechanically. A trader borrows 1,000 shares of stock XYZ from a broker, immediately sells them in the open market for $50 each, $50,000 total, and pockets that cash. But those shares weren't theirs. They were borrowed, which means the trader now carries an ironclad obligation: return 1,000 shares to the lender, no matter what the stock does next. Every short position is, at its core, a future buy order that hasn't been placed yet. Now look at the math on that obligation. The trader sold 1,000 shares at $50, collecting $50,000. If the stock falls to $30, they buy back for $30,000, a $20,000 profit. Clean. But if the stock climbs to $80, they have to pay $80,000 to return shares they sold for $50,000, a $30,000 loss. And unlike owning a stock where the worst case is the price goes to zero and you lose 100%, a short position has no ceiling on losses. The stock can double, triple, go up tenfold. The short seller owes shares at whatever price the market demands. When enough traders are short the same stock, their combined future buy obligations become a measurable pressure. That's what short interest as a percentage of float captures. Take a company with 10 million tradable shares, its float. If 2 million of those have been borrowed and sold short interest is 20%. That 20% represents a block of shares that must eventually be repurchased. At readings above roughly 20%, analysts consider a stock heavily shorted. GameStop in January 2021 hit approximately 140% of float sold short, meaning more shares had been borrowed and sold than actually existed in the tradable pool. That's only possible because a share sold short can be lent out again by the person who bought it. The obligation pile was enormous. Short interest percentage tells you how big the obligation is. Days to cover tells you how trapped the short sellers are. The formula is simple. Divide shares sold short by the average daily trading volume. If a stock has 10 million shares short and trades 1 million shares a day on average, days to cover equals 10. That means if every short seller tried to buy back simultaneously, it would take 10 full trading days of volume just to get them all out. And while they're buying for 10 days straight, they're pushing the price higher every single hour. Above roughly 5 days to cover, short sellers start to look genuinely trapped. They can't exit quietly. So you have a heavily shorted stock with high days to cover. The fuse is set. Now compare what happens when the price moves against a long investor versus a short seller. A long investor who buys at $20 and watches it fall to zero loses 100%. Painful but finite and known in advance. A short seller who borrowed and sold 1,000 shares at $20 collecting $20,000 faces a completely different math when the stock climbs to $50. To return those shares, they need to spend $50,000, a $30,000 loss on a $20,000 trade. That's 150% of the original sale value already gone. And it gets worse with every dollar the stock climbs. There is no natural stopping point. Brokers don't wait for losses to spiral unchecked. When a short position's losses eat into the margin the trader posted as collateral, the broker issues a margin call, a demand to either deposit more cash or close the position immediately. The trader may not want to buy back at $50. They may be certain the stock is heading back down. Doesn't matter. The broker forces the purchase. This is the critical mechanical detail. It isn't sentiment or panic that drives short squeeze buying pressure. It's contractual obligation enforced automatically at the worst possible moment when the price is highest and every purchase adds fuel. Put all those pieces together and you get a feedback loop, one that can run almost autonomously once started. Rising price triggers margin calls on the weakest, most leveraged short sellers. Their forced buying pushes the price higher. That higher price crosses the threshold for the next tier of shorts. Those are forced to buy, which pushes the price higher still, which forces the next tier. Each wave of forced buying is self-funded by the very price movement it creates. Reinforcing loops like this are rare in markets. Most forces are self-correcting. A short squeeze is one of the few genuinely self-amplifying mechanical events that the market structure itself produces. The GameStop squeeze is the textbook case with real numbers attached. On January 12, 2021, shares were trading around $20. Short interest was near 140% of float. Days to cover was extreme. Then retail investors coordinating online began buying aggressively. The initial price move triggered margin calls on leveraged short positions. Those forced buybacks lifted the price, which triggered more margin calls, which produced more forced buying. 12 trading days later, on January 28th, the stock hit an intraday high of approximately $483. The people who were most certain the stock was worthless were the ones mechanically driving it to the moon. To feel the scale of what 200-300% means mechanically, a short seller who borrowed and sold 1,000 shares at $20 collected $20,000. To close that position at the $483 peak, they'd need to spend $483,000, a loss of $463,000 on a $20,000 trade. That's not a bad bet that went wrong. That's a number that destroys accounts, triggers institutional emergency procedures, and forces selling of other positions to raise cash. The short squeeze doesn't just hurt the shorted stocks bears, the forced liquidation of other assets to cover losses can ripple across unrelated markets entirely. Every squeeze, no matter how violent, has a boundary, because the feedback loop has 3 exits, and eventually one of them opens. First, short interest gets covered. As short sellers buy back shares, the total short position shrinks, removing fuel from the loop. Second, new short sellers enter at the elevated price. At $483, a trader who shorted at $20 is desperate to exit, but a new trader who shorted at $400 has a completely different risk profile and adds fresh supply. Third, the original buying momentum fades. If retail investors stop buying, or if brokers restrict purchases, as happened with GameStop, the demand that was sustaining the price collapses, and no new trigger arrives to start the next wave. GameStop's collapse was as mechanical as its rise. From the $483 peak on January 28th, the stock fell to roughly $50 by mid-February, a drop of nearly 90% in about 2 weeks. Short interest had dropped sharply as positions closed. New short sellers entered at elevated prices, replacing the buy pressure with sell pressure. And retail buying, some of it restricted by brokerage platforms, dried up. The feedback loop reversed direction. The same mechanical forces that produced the rocket-like ascent, position obligations, margin requirements, liquidity constraints, now worked in reverse, collapsing the price with equal speed. Now the complete picture assembles itself. Short selling isn't merely a bearish bet, it manufactures a latent buy obligation. When enough of those obligations pile up relative to available float, and when days to cover extends high enough, the stock becomes a loaded spring. Any catalyst, earnings surprise, news item, coordinated retail buying, can release it. The bears, by shorting heavily, have paradoxically created the very mechanism that can turn them into forced buyers who rocket the price skyward. The most aggressive pessimists in the market become, involuntarily, its most aggressive buyers. The deeper lesson in all of this isn't about GameStop specifically. It's about how market structure itself can produce violent, counterintuitive outcomes with no fundamental cause required. A stock can explode upward not because it became more valuable, not because investors reassessed its prospects, but purely because of the geometry of who owes what to whom and how trapped they are. That's the uncomfortable truth at the core of a short squeeze. The price is being set not by analysis of the company, but by the mechanics of an obligation. The opening hook had an answer all along. The people who were most wrong about a stock were the ones who sent it to the moon.